Well, you get the picture now. So we now move to things like tangible assets, like energy and precious metals and industrial metals and commodities. Currency, when the interest rate is changing, it's also impacting the US dollar. Rising interest rates impact the dollar as a strengthening asset, and falling interest rates impact the dollar as a weakening asset. But understanding these pieces is critical. Now, business interests, which are more private, meaning that they're not publicly traded like a stock is, they're going to be impacted by the economy and the markets, but not the same way because they're not publicly traded. So therefore, they give us some opportunities to avoid some of that risk and give us the ability to have some growth in income or both to help our clients maneuver the markets and minimize risk. And it just depends on where you are in your financial investments, your needs, and so on, whether some of these programs will work for you or whether they really won't work. Now, finally, we have insurance and annuities. And insurance and annuities are simply all of these other models with riders or covenants put onto the contracts that can protect income loss, that can protect capital loss, that can protect a death benefit so that the value won't go down if the market does, make it so that you can have income with steady, stable income for your life. They can simply be modeled after some of these other buckets and have these stabilizers put in them. Back to our probability and surety discussion from last month. Putting these together in a different portfolio for each person is part of what our job is. And it might seem complex, but in reality, it's working with the very basics of what we're trying to do and then building on those basics to meet the client's needs, whether that's income or growth or cash reserve, tax management. Mixing these together is almost like a recipe. I'm almost like a financial chef, making everything come together for each client's needs. But there's a lot of similarities in the portfolio. They're just built differently to accomplish different goals, much like options you might buy in a car. One car does one thing, and the same car with different options does a little bit different. Same things here. But it starts with understanding the cyclical nature of investments. The asset cyclical management process is a big opportunity, a big piece of that. That's why this statement here says proactive wherever possible and reactive whenever necessary. Interest rates rising create one set of problems. The tightening of the US dollar creates other problems. The stock market falling creates other challenges. So what we try to do is to work through these opportunities to have a good set, stable model, but with the ability to make adjustments and to flex as we need to for our clients' ultimate goals of creating, growing, protecting, and preserving family wealth. And using this cyclical model for assets is part of how we do that.